So very interesting learning module. We're going to be looking at what is the process of securitization. So it's going to be a long introduction actually, because we're going to, before we get into what is securitization, I will have to explain to you what is the originate to distribute model. Then we will get into the benefits of securitization, and then finally into more detail about the securitization process. So let us get into it, right? So what are we going to cover? First, I will give you an introduction, explain to you what is the originate to distribute model. Then we will cover the benefits of the securitization process, and then we will actually discuss what is the entire process. So what is securitization, right? What are asset-backed securities? So before I can explain to you what is securitization, what I have to explain to you is something called the originate to distribute model. Right? And there's nothing wrong with this model. It's a very good model, but it was through this model that we created some securities which were actually not very good, and that led to the financial crisis, right? So I'll explain the whole thing to you, and then you will be able to understand that what exactly happened in the 2008 global financial crisis, right? So first things first, what is the originate to distribute model? Let's say there is a bank, and this bank is giving out home loans. Now, let's call these home loans mortgages, right? And there's a lot of people who are taking these home loans. Different people, they are taking loans for their different homes. Usually, home loans are for very long periods of time, 20 years, 25 years, 30 years. So now this bank is just sitting and waiting on these payments, right, to come back. And let's say this bank has deposits of roughly $100 million, just taking a random figure, and it has given out loans for $100 million. And now it has no more money, right? The deposits are not growing that much, and all of the money they have given out in loans, they cannot give out any more loans because they don't have any money. And I know you must be thinking that a bank doesn't give out all of his deposits into one type of product, and you're completely right. But that's not what I want you to focus on right now. Just assume, hypothetically speaking, that whatever money it has given out, and it cannot give out any more money, right? Because it doesn't have any more money. So what the bank wants to do in this scenario is that it wants to originate more loans, it wants to do more business, but it can't because it's stuck with these loans for the next 30 years until these people pay it off, right? So it gets an idea. It has originated these loans. Now it wants to distribute these loans. So that's where the originate to distribute model comes in. Now what happens? It sets up a company, a special purpose vehicle or a special purpose entity, right? It's a company made solely for the purpose of securitization. Now what does that mean? It will take these, the bank will take these loans and it will transfer the ownership of these loans to this new company, SPE, special purpose entity or special purpose vehicle. Then what the SPE will do, it will issue securities, right? This is where the securitization process is coming in, that these loans are converted into securities. So they are being securitized, right? They are being securitized. And these securities are called asset backed securities, because these bonds or these securities, these financial assets that are being issued, are backed by these loans. So this is the asset, right? What's the asset? The pool of receivables. So this is essentially, these mortgages are receivables for the SPE, because these people will be paying their mortgages, right? There's cash flows coming in. So that is of course a receivable by the SPE, because it now owns this pool, because the bank transferred the ownership to the SPE. And based on that, backed by that asset, these securities are issued. Now, these asset backed securities are purchased by investors, right? So let's say investors pay that 100 million to the SPE. The SPE gets the 100 million and then gives that to the bank. Now, the bank is happy because then it can originate new loans, right? It was able to liquidate its existing loan portfolio, and now it can originate new loans and create new business. So this is the originate to distribute model. Now, what went wrong in the 2008 global financial crisis? See, the bank knew that the loans that it was originating, it had the intention to distribute them. And since it was not going to keep them on its books, it was going to sell off those loans, it was going to get rid of those loans. It didn't care about the quality of those loans, because it wasn't going to be its problem, right? It was going to be the problem of these investors who were going to buy these securities, which would be backed by those loans as the asset. And if the loans were bad quality, well, the bank wouldn't have to care, because they would have already gotten their money, right? It would be the investors who would be stuck with the loans. So what they started doing was they started originating very bad loans, what we call subprime, right? They started giving loans to people who were buying property and taking loans to buy that property, which they shouldn't be doing, because they didn't have the capacity to buy that property, right? They didn't have any income, they didn't have any jobs, and still they were being given the loans by the banks, because the banks really didn't care, because they knew that they wouldn't even have to wait around for 30 years to collect the money, right? And they would just get their cash now, because they would just distribute the loans. And this is what created the 2008 financial crisis. Now, of course, things have changed. Now the bank is responsible. It retains a certain responsibility after issuing these securities. And we'll talk about that later, that what has changed after the 2008 financial crisis with respect to this entire securitization process. But before I get into what has changed, and that will be discussed in a separate learning module, but first I want to explain to you why the investors are interested in this type of process, right? And why the bank likes it, and why these guys, the borrowers, like this as well, right? So first of all, obviously the benefit to the bank is very clear, because they are able to liquidate these loans and get their cash early, right? They don't have to wait for 30 years. They get their cash early, and then they can originate new loans. Number one. Number two, the bank or the original originator or the seller, the original seller, it usually stays on board as a service provider it helps with the collection of the payments from the borrowers and takes a service fee as well. So the bank is actually really happy. They're able to liquidate their loans and they stay on as a servicer, collecting the payments, servicing these mortgages, and collecting a service fee on top of that. Now the investors are happy because they get to invest in a completely different type of security, right? Which is backed by home loans or mortgages, which is something that traditionally they've not been able to do. Because traditionally what would happen is that maybe they can become a depositor in a bank, right? Maybe they can place the money as a deposit and the bank would then give out the loan, and maybe it would earn, let's say, 7% on the loan, but it would only pay 5% on the savings deposit. So what you're essentially doing over here is you're taking the bank out of the middle and you're directly connecting the investor with the borrower, right? And maybe they can both be happy with 6%. So the borrower doesn't have to pay 7, the investor doesn't earn 5, they earn 6. So they are both happy. In this process, by the way, it's called disintermediation, right? Because the bank is an intermediary, is a financial intermediary. What a bank does, it makes the borrower and the lender meet, so it intermediates between those two. But when you take the bank out of the middle, then this is disintermediation, and it's actually good for the borrowers because they get a lower rate and the investors get a higher rate. So it's good for them, and there are other benefits as well, and we'll talk about the other benefits as well. But this is the high level concept I wanted to introduce to you, which is securitization, right? So what is securitization? It is the process involves pooling relatively straightforward debt obligations such as loans or bonds using cash flows from the pool of debt obligations to pay off the bonds created in the securitization process, and these instruments become part of the pool called the securitized assets. So what does that mean? There's a bank, it has a pool of assets. Now those assets could be mortgages, they could be it could be loans such as corporate loans, it could be credit card debt, it could be auto loans, any kind of loans, which then of course is a receivable for the bank to get back. So it is an asset because a receivable is an asset, and it makes a special purpose vehicle, it transfers the ownership of this asset, and then that special purpose vehicle issues securities, right? And these securities are backed by this asset. So what we call them is asset backed securities, right? Now if that asset is, let's say, mortgages, then this type of asset backed security is called a mortgage backed security. If that asset is, let's say, something else, like a loan or a debt, then it would be called something else. But in this specific case, since we are talking about mortgages, then this type of an asset backed security is called a mortgage backed security, right? So these are the buyers, or rather you can even call them borrowers, right? And these borrowers are the ones who are going to be paying back their loans, right? And that is how the pool of loans is developed. The originator is the bank, the original seller, the originator is the bank. They make the special purpose vehicle, they transfer the ownership of the pool, and then the SPV issues the securities, mortgage backed securities, right? And then investors pay for those securities, and then the SPV pays the bank for that entire amount. So this is the process of securitization. In this particular case, it would be called a mortgage-backed security, right? Which is an example of asset-backed securities. Okay, so what have we discussed so far? There are three parties. There's the borrowers, there's the investors, and of course there is the bank, the intermediary that is connecting them, why they're interested, why all three parties are interested in doing it, because investors get access to a new asset class which they otherwise probably cannot serve without the bank. Right? I mean, you as an investor cannot go around offering people to take a loan from you to buy a house. Maybe they need to buy a house for 100,000 and you only have 10,000 as an investor, right? And even if you have 100,000, it's much more risky to give it to one individual than to give it to a pool of individuals, because the risk gets divided, right? So even if one person doesn't pay back their loan, you as an investor, so there's hundreds of investors here, there's hundreds of borrowers here. Even if one borrower defaults, the risk is distributed across the 100 investors. So it's not like you lose all your money, right? But if you were just an individual investor and you give it to an individual borrower, then that's too risky. So this way, through these asset-backed securities, investors, even with relatively small amounts of money, can get into a much bigger pool and get access to this relatively interesting and different asset class, which is mortgages. So investors get access to a relatively illiquid asset class through a liquid security. They can even get out of it if they want, right? They get these cash flows, which is of course coming from people paying their mortgages. So investors that like these type of stable cash flows, like pension funds or insurance companies, will be interested in buying them, as long as the pool, the loans are good quality, right? I mean, obviously garbage in is garbage out. So if the pool is all consisting of loans which are bad quality, those mortgages have been given to people with no income and no jobs, that's going to be bad, right? So obviously the pool has to be good. But otherwise, of course, it's a very, very good model, originate to distribute. And this entire securitization process is a very good innovation in the financial system. But what we have learned from the global financial crisis, that the quality of the loan has to be ensured, and that can be done by keeping the bank responsible in a way, even after it distributes those securities. And we'll talk about that in a different learning module. But just to give you a point here, that they are called covered bonds now. That even after issuing the securities, even after originating and distributing the securities, if the loans go bad, the investors can, and the SPV can come back to the bank and say, hey, what have you done? So give us our money back, right? So it's covered. Those bonds are covered not only by the asset, not only are they backed by the asset, the pool itself, but also by the bank that issued them. So the bank stays responsible. Anyways, that's not what we are talking about in this learning module. What we are talking about in this learning module is securitization, its benefits, and its process. So let's talk about the benefits. We're talking about the benefits to investors right now. What other benefits do they have? They can get access to this very interesting new asset class, and it gives exposure to real estate without actually investing in real estate. Right, what's the benefit for the bank? Well, number one, it gets the ability to lend more money, right? I mean, it is able to liquidate their portfolio and then go on and originate more loans. And it increases efficiency as well because of the disintermediation, right? Which is taking out the intermediary from the middle, which is good for the borrowers and good for the investors, because then it just takes out the bank's margin from the middle. So it's good for the entire financial system, and it's good for the bank as well, because then bank can go on and issue more loans, originate more loans. And the bank usually stays on board as the servicer. It's not necessary for them to stay on board. It's not necessary for the SPV to appoint the bank as the servicer, but usually this is what happens, that the bank stays on board as the servicer and does the collections and charges a service fee. So the bank, without the risk, continues to make money, right? It transfers the risk to the investors, but still continues to make money on the servicing. So it's a win-win for everybody. The borrowers obviously get lower rate, the cost decreases for them, because that whole pool offers a diversification benefit to the investor. Now, an investor can buy a liquid security and have access to this diverse pool of mortgages. So it really offers them a nice diversified investment, and therefore they're willing to accept a relatively lower rate for it, whereas they would ask for a much higher rate if they were giving a loan to an individual, right? So it's good for the borrowers, good for the investors. So anyways, let's take a break here. We'll come back and then we'll get into the process.